Good morning, good afternoon, or good evening, depending where you are on the planet. And welcome to the Bull versus Bear webinar today on TGI. TGI, thank God it's Friday, the 6th of October, 2023. Here we go for Jobs Day. It's the US employment report. I started in markets all the way back in 1991, straight out of university, onto the the London International Financial Futures Exchange. So the CME, which is what you guys are trading on when you trade with Trade Day, or CME data from the futures market, is the Chicago Mercantile Exchange, which is the big exchange in Chicago for US futures markets. And the equivalent in Europe, for the whole of Europe, was the London International Financial Futures Exchange. We had all the big products for Europe. So the equivalent of the S&P for the European markets and for the UK market, and also for the European and UK bond markets, etc. And I started in 1991, and the biggest day of the month was always Jobs Day. Okay, and I learned that very quickly. In fact, I knew about Jobs Day. I knew about the US employment report because people that I knew who worked in the financial markets used to speak about it. You guys should know about the jobs market. You should go the jobs report, okay? And, kind of no excuses. I'm a technical trader, Steve. I get it all the time. I'm a technical trader. I don't need to know the fundamentals. The fact that I'm preaching to the converted, because you guys are onto a webinar where I mostly talk about the fundamentals and the macroeconomic. But for those who are watching on maybe a catch-up video, right, please, start paying attention to some of the fundamentals. You need to know when Jobs Day is. You need to know when the CPI data is. You need to know when the Fed speakers are speaking. You need to know when Powell speaks. You need to know when the FOMC minutes are. You need to know when the FOMC meetings are, particularly the meeting minutes, the meeting itself and the interest rate decision, the US CPI data and the US employment report, because those are the only four events if you're trading the normal markets. So you're trading energy, okay, then we have to, or agricultural products, you've got the agricultural reports, you've got the energy reports. You're not allowed to trade over those. But most of you are not trading those. Most of you are trading the ES and the NQ. You're trading US stock indices. And for those, the only 4 points that you cannot trade, and it's 2 minutes before and 2 minutes after, is the jobs report. We have that today. We have that in just under 1 hour. It's 1 hour from when I started the webinar, okay? So in just under 1 hour, wherever you are, okay, in the world, okay, I'm not going to go for all the different time zones. Well, I will. You know what? It's 7:30 Central. It's 8:30 Eastern. I know all these. I don't live in those places. 7:30 Central, 8:30 Eastern. It's 1:30 in the afternoon if you're here in the UK. If they're on Central European time, it's 2:30. I'm not going to go into all the Asian hours as well, okay? But it's Jobs Day today. Please know that it's Jobs Day. You cannot trade the economic data with Trade Day for 2 minutes before and 2 minutes after the data, okay? I feel like this is turning into a lecture and you're not children. Okay, so I just want to say that and make that very, 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 very clear. We put it all over the site. It's in the Discord. It's on the forums. We sent out an email. We sent out an email yesterday. Sent out an email today. I can guarantee you there will be traders who fail the challenge today because they trade over the data. We do not allow trading over these data points. And it's only on the data points, it's 4 minutes in a whole trading month. 4 minutes. Sorry, no, it's not. It's 8 minutes. 4 minutes today and 4 minutes on CPI data. Okay, on the data. On the central bank side, it's 4 minutes on the interest rate decision, which comes about every 6 weeks, and 4 minutes on the Fed meeting minutes. Yeah, every 6 weeks. Okay, so that's it. Okay. Did TradingView change their free policy to only 2 indicators? I have no idea, Dominic. I don't work for TradingView. Okay, TradingView is just a plugin. We have lots of different platforms and I can't keep a track on all their different things. Right? If you have a subscription with them or you have a free, take the free service. I do have my TradingView account. Okay, but I have a pro account, so I don't know what they're doing on their free policy. So I would suggest you check that out with TradingView, not my company. Sorry, can't answer on other companies, third parties, companies' behalves, okay, when they make changes. Okay, so my apologies. Right, but yeah, go check it out with TradingView. Put a ticket into them. So, no trading today, 2 minutes before or after. I've got very little to say today, guys, right? It's going to be all about the employment report, right? So you need to keep an eye on it, right? And you need to know you can't trade 2 minutes before and you can't trade 2 minutes afterwards. You can take a look in here on this calendar where, Non-farm payroll, we're looking at 170,000 is the anticipation. Average hourly earnings could be important as well, because obviously that gives the inflationary pressures, and the unemployment rate looking for 3.7. So we're watching out for all of those. Okay, it's all about the employment report today. Okay, I'll run through some articles. I'm not going to go into it. It's going to be a fairly short. I've been lecturing you for 5 minutes now on the employment jobs report. No trading 2 minutes before or 2 minutes after. Not only no trading, no orders in the order book. No orders in the order book either. No trading, no orders in the order book. Okay. Right, 5 things you need to start today. Jobs day. Okay, we've already covered that. We don't need to go into loads of depth in there. ADP employment member was weaker than expected. So maybe the market is ratcheting down from these numbers. Okay, the numbers we just looked at in here, the expectation is probably a bit lower because we had a lower number from ADP. Okay, so maybe the market's already expecting something a little bit lower. Okay, the market probably reacts positively to weaker data. Okay, that's kind of counterintuitive, but weaker data would mean then the Fed. We don't want it too weak because then it shows we may be going into recession. But a slightly weaker data might mean the Fed won't hike. And if the Fed don't hike, the market's like that. Okay. So, and we're still expecting, well, the market is not pricing in a Fed hike, but the Fed tell us they're going to hike. ExxonMobil in advance talks to buy Pioneer Natural Resources. Yep, don't really care. Doesn't really impact us. Bonds will rally big next year. Michael Hartnett, Bank of America. I used to work with Michael. Okay. He's a really, really, really nice guy. Super nice guy. His sister is actually a top chef here in the UK, top chef, or one of the best hotel restaurants, a 5-star Michelin starred chef, Angela Hartnett. Okay, I know Michael very well, and he's a great analyst. And I worked with him when we were at Merrill Lynch, Bank of America, and now he's still at Bank of America. He's looking for bonds to be the best performing asset class in the first half of 2024, looking for a rebound in this big bond. Remember, this bond sell-off's been massive. Okay, so yeah, Hartnett's looking for that, but Citigroup recommends buying the dip in equities. They're looking for equities in an advance of 15% in global stock indices. I'm with them on that one. I think they're both right. I think we'll see both bond markets. We've seen bond markets and stocks selling off. They can both rally as well. So I wouldn't be surprised if we see both of those happen. Markets waiting. Not much happening over here at night. Chinese markets, remember, been on shut for Golden Week all week. And oil having had a really big sell-off, and then again back to the jobs market. So it's basically jobs. It's all they're kind of talking about in there today. And then also we got like stock future signal recovery before US market jobs data. Treasury yields extend advance, and Treasury yields trying to rebound. There is some news on Tesla slipping in pre-market. I think they changed. I think we'll see it on here somewhere. No, I did see they've cut prices again. I think they cut prices on the cars overnight in here. So yeah, what else we got? It's all about the jobs, right? September jobs report may be last good one before sharp slowdown. So potentially, the interest rate hikes we've had kicking into the jobs market. It's been slow to kick into that jobs market. So oil stabilizing at the moment, but WTI more than 9% down. Okay, a top in oil. That's going to be good for stocks. Okay, it puts a brake on the brake that potentially higher oil prices could put on the economies, the global economy. Maybe that brake not so hard on with the market moving back lower in oil. And 5% bond market means pain is heading everyone's way. Higher bonds, okay, is going to mean higher long-term interest rates, okay, potentially higher mortgage rates in the US and higher mortgage rates potentially globally as well, okay, with bond yields moving higher across the board, across continents, okay, not just in the US. It's been happening in Europe and the UK as well. There's not much in here. On the macro this is there. This is the same name as we use on our macro matters, but you can see in here there's nothing really significant in here. You see, look at these macro matters in here. Nothing really much from Reuters. It's all going to be about bonds. And if we jump in here to the US side, in here, so look, global economy glides to soft landing, gets bumpy as bonds stick. So we were looking for soft landing, maybe not as soft now as bond yields go higher. Futures muted, for futures little unchanged. US jobs data could be the Fed's cue to hike or hold. Yeah, so that's what I was talking about. The jobs data, if we get slightly softer jobs data in here, softer by softer, meaning lower than expected, okay, it might mean that the Fed don't hike between now. Remember, we're looking for one more hike maybe before they're done, and maybe they won't hike before the end of the year, okay? And if they don't hike before the end of the year, that's going to be obviously positive for stocks. So maybe slightly weaker jobs data equals stocks actually going up, and oil soothes but jobs dictate, so oil's obviously pushed lower. If we see where we are, so yesterday markets ended up slightly low, but didn't really do too much yesterday. It was kind of slightly lower, slightly back higher again. Slightly up, slightly back down again. And this morning in here, we're actually slightly higher going into the jobs data, but it's all going to be about the jobs data. On the overnights, it doesn't really matter too much in here, but Europe slightly up this morning, actually doing slightly better. And Asia, obviously China has been closed in here. But Nikkei was 0.25% down this morning. I'm not going to go through loads. It's going to be going with the break. We kind of covered all these levels more recently. Here's the NASDAQ, sitting right below. It went right up, literally went right up to that 13-period EMA. See the 13-period EMA in here? It's a really good short-term change in direction indicator. So that's going to be critical going into the day for me. On the top side, that's sitting at 14,955. Up through there, could see a quick sprint up to the recent high, which has been 14.81. Sorry, no, it's wrong. 15,060.75. That's a key level because that creates a double bottom down here. If we put it on the 30-minute chart, that 15.0675 level is up there. Okay, creates the double bottom. There's the low double bottom through that level. So those are the key levels on the NASDAQ. If we go to the ES, we're a long way from that 13-period EMA. The ES rebound has been far more lackluster. But you can see it seems to be finding resistance around here. And if we go and see onto the 30-minute chart, top side, it's failed multiple times around here, where it's just gone up to more recently in here, around 43.05, okay, 43.06. That for me is more of an important level there, though. It needs to get up through there, 43.17. So 0.56 kind of area, and then 43.17 on top side. Downside, you're probably looking at, the trend line that maybe comes across the year, but ultimately it's down through these lows here, right? So 42.57. 54.57, little overnight lows around 42.82.81 on the ES. Okay, guys, I'm going to wrap it up there. And it's really just, for me, it's go with what happens, really. For me, I'm bullish. I'm looking at, I think we've got a bottoming pattern going in. We've spoken a lot about bonds. I'm not going to go through all the bond markets. And, a quick nod to the bond price on the 10-year. But in here, look, it looks like it's trying to bottom. We reversed this trend line, but it went right up to this little resistance zone in here. It needs to get the bond. This is the 10-year note, needs to get above here. So 10-year notes need to get above that peak there. We flagged it yesterday, 107.14. Up through 107.14, it looks, and then you've got 14 and a half, I think, no, 15. 14.15, key levels on the top side for the US 10-year. If we can get up through there, then this is a better bottoming pattern, and then we could see further upside in bonds. And remember, further upside in bonds is likely to see significant further upside in stock indices as well. Any questions? Remember, no trading or orders in the working orders in the order book or any positions 2 minutes before and 2 minutes after the data today. Okay? All right, guys, enough of the lecture. Have a great trading day. Go and smash it today, guys. You do well. And helmets and goggles on in what now? We've got less than 45 minutes. And I'll be back with you and we'll take a look at what the market has done when we come back on for the next Bull versus Bear webinar on Monday. Cheers, guys. Bye.